Imagine that you have a friend who is in a dire need of money. So he asks you to lend him $100 and he promises to pay you back in 1 month. You being the nice person that you are, you do give him $100 and you hope that you will get your money back in the time frame that your friend mentioned. However, it is during this entire 1 month duration that you are faced with a risk, and that risk is credit risk. And what that credit risk says is that you might not get your $100 back when the time comes due. And that is exactly what happens. After 1 month, when you ask for your money back, your friend says he has no money to pay you back and he decides to bolt on you. All you can now do is run after him and chase after him to get your money back. So that is the concept of credit risk. More specifically, if I talk about the exact definition, credit risk is the possibility that a borrower, and that borrower could be anybody, it could be an individual, in that case, in the last example, your friend, a company, or government, and the possibility that the borrower will fail to meet their financial obligation in full and on time, such as not paying interest, principal, or loan or bond. That is your credit risk. Now, in credit risk, there are three important components. The first one is probability of default. Probability of default is nothing but the likelihood that the person who is the borrower or the individual who is the borrower will default and not pay the money back in time. The second component is loss given default. This is the amount that you will end up losing in case there is a default. So let's say in the previous example, your friend says, after 1 month, your friend says, I can only pay you back $20 and the remaining 80 I cannot. So in that case, your loss given default is 80% because you could only recover 20% of what you had initially loaned. Right? So in that case, your loss given default is 80% and your recovery rate is 20%. So loss given default is also 1 minus your recovery rate. And then lastly, there is exposure at default, which is the amount that was outstanding when the default occurred. So in this case, when the default occurred, the amount that was outstanding was $100. So that is your exposure at default. And with these three important components, we derive an important formula, which is expected loss. So this expected loss is the loss that will happen in case the counterparty or the borrower, in this case, defaults. And that is calculated as probability of default into loss given default into exposure default. So this is a very basic overview of what credit risk looks like. Do let me know in the comments if you want me to dive deeper into types of credit risks, talk more about these components, and some more real life examples. If you like this video, please like, share, and subscribe. Thank you.